Lauren Summers. I'm Senior Director of Lifelong Learning and Travel at the Yale Alumni Association. This is our third Yale Alumni, or it's not our, well, it's the third session of this week's Yale Alumni Academy Climate Change session, but it is the fifth annual Climate Change Conversations series. We started this series in 2020 with the goal of allowing the alumni community to connect into the scholarship happening here at Yale around climate change. We're very pleased to be partnering with Yale Planetary Solutions as our partner for this climate change series. There are 6 sessions being offered. Usually we time with the COP event. And so some of you may be attending that event or aware of it. And today's presentation is co-sponsored with the Yale Center for Business and Environment. Our presenter is Todd Cort. Todd works at the intersection of sustainability and investor value. And over the course of 20 years in consulting and academia, he has applied scientific and economic lenses to corporate, social, and environmental responsibility. He seeks to identify the tools, mechanisms, and metrics that create the greatest value for investors, business, and society. Todd's experiences range from on-the-ground implementation of sustainability programs to corporate-level communication and investor strategy development. He has also worked extensively with communities, regulators, policymakers, and internal stakeholders. He serves as the faculty co-director for the Yale Center for Business and the Environment and the Yale Initiative on Sustainable Finance. In addition to his appointment at the Yale School of the Environment, he serves on a variety of advisory boards, including the Just Capital Scientific Advisory Board, the Prime Coalition Academic Advisory Committee, and Merck Sustainability Advisory Committee. He's the director of Impact for the Impact for the Good Science Fund, a venture capital fund in climate and health tech. And he is also the former board chair for Save the Sound, a regional environmental nonprofit serving communities around the Long Island Sound. Welcome, Todd. It's a pleasure to have you here today.
Thank you.
I'm going to pass over to you to get your presentation going.
Thank you very much. Let me pull up the presentation. There's Nikki already introduced herself. There's a Nadi is also on. I wanted to say hi to Nadi. And very interesting because this is such a small world. Someone's dialing in from Three Rivers, California, which is it's amazing because that is where I spent most of my summers growing up, because that's where my father owned an art gallery called the Cort Gallery. Still there, actually, although my father passed away. So I love Three Rivers. It's a great place. So welcome, everybody. Thank you for the introduction. Today, I want to spend a little bit of time introducing you to this idea or concept called ESG. Some of you will know it. Either you'll at least know the acronym, or you'll be familiar with some of the concepts, or you might be a deep expert. In either case, I'm hoping that you can take something away from this conversation. I'll try and speak for a while, maybe 30 to 45 minutes or so, and leave plenty of time for questions after I wrap up. So thank you again for having me. There are a number of roles here at Yale that I fill, but all of them have this common theme, which is about sustainability and finance. This idea that there are aspects of environmental and social responsibility that tie to or correlated with or drive financial productivity within companies and investments. So today I want to talk about one of these core concepts, environmental social governance categories, and give you a sense of where that space is today. For those of you who know me, and I know a couple of you know me from work past, you'll know that I have two kids, 2 daughters. They're both kind of in the adolescent space right now. So one's 11 years old, almost 12, and the other is 14, going on 80. And so this talk is kind of an homage in that ESG is in the similar space. It is in its adolescence. It has grown up It has become a force in the finance world. It is mainstream in many ways, but in a lot of other ways, it's still figuring itself out, and it still has a lot of challenges. So I went out and I looked at what are the characteristics of an adolescent, and this is where what I found just on my first Google search, and lo and behold, these characteristics pretty accurately describe what ESG is going through right now. So I structured my talk today around these aspects or characteristics of adolescence. We've got growth and development. ESG is growing. It's getting bigger. In fact, I'll try and give you a sense of how big ESG is as part of the financial world today. However, even though it's growing, it's very undefined still. As an adolescent, it's trying to figure out who it is. What does it mean? What's covered by ESG and what's not covered by ESG? It's getting more and more authority in the world. It has more and more decision-making authority and power to create change. But at the same time, it's facing increased pressures. So people are looking at ESG and arguing about what it is and what it's not good for. And a few years ago, it actually entered into the public political domain. So I want to talk about that a little bit. And then finally, this kind of search for self. Who does ESG want to be in the future? Where is it going? And I want to wrap up on that to give you a sense of where I think this topic of sustainable finance and ESG is going to wind up over the next few years. And we can talk a little bit about the current political situation and the administration and what that might mean for ESG over the next 4 years at any rate. So let's start with growth and development, just a random picture. To talk about growth and development, ESG has grown up. We have to talk a little bit about what ESG is. What does it include? So it turns out that ESG is actually a lot of different things to a lot of different people, and everyone brings their own baggage and their own understanding of ESG to this space. For those of you who are interested, the Center for Business Environment, which I co-direct, we produced a series called Beyond the Buzzwords, and I've got the website here down in the lower right corner. And we have a section on ESG. What is ESG? And I pulled the definition from that website, but there are hundreds of definitions. So I just want to acknowledge that this is one of many. So ESG here refers to criteria that investors use to assess risk and opportunity relating to a company's environmental impact, social responsibility, and corporate governance. So what is that? I want to pull out some of those words for you. It is criteria used by investors. Those are the first two and most important words here. These are the criteria that investors are using to make investment decisions. So one investor might come to this ESG topic with a very different perspective than another investor. One investor might come in and say, I think that clean energy is a good investment. So energy, green energy, renewable energies, those are things that I believe are investable products. And therefore, I'm going to put my money towards those. So I'm using a criteria of clean energy in order to make an investment decision. Another investor can come to that exact same topic area and say, I don't think clean energy is going to be an investable decision. I think it's going to lose money, but I'm still going to use that criteria to make my investment decision. So ESG is not political. It doesn't say that we do invest or don't invest. It just says that it's a set of criteria that we use for our investment decisions. In that way, it's very, very similar to any other financial data because investors are using that information in order to make investment decisions. So a lot of the debate that we talk about in ESG is not about the topics, but rather, are those topics financially material? And I'm going to dive into that a fair bit because I think that distinction of what does ESG tell us about financial performance is really where a lot of the controversy, such as it is, lies with ESG. So when we talk about these criteria, what are we talking about? We're talking about performance, risk, and opportunities. How can I make money? Where might I lose money? And how do I measure historic performance in order to evaluate what the future holds? Those are the types of criteria that we're looking at. It is inherently subjective, ESG, because different investors, different stakeholders will bring their own sense of what ESG means to this conversation. But at the end of the day, the one consistency is that it talks about environment, social, and governance data. So what are these environmental, social, and governance topics that we're talking about? Those are fairly consistent. I'll say consistent, but I'm going to underwrite myself a little bit. So this is just a snapshot of typical topic areas that are in the ESG umbrella. On the environmental side, you'll recognize all of these things like climate and biodiversity, pollution, water, both water usage and water quality, agricultural use, fertilizers, and runoff into waters of bodies. Those are the kind of environmental topics that may or may not have financial repercussions on a business. On the social side, it's things like human rights and labor rights, health and safety, occupational health and safety, inequality, socioeconomic inequality and poverty, education and access to education, diversity, equity, and inclusion topics are frequently included under the social category. Community development and economic development within regions is usually included. And then on the governance side, ethics, governance, transparency, and innovation are typical types of topics. Now, it might look like a small list. And of course, these topics can include a vast number of smaller subtopics. And there are lots that I haven't listed here. These are just the most common. Just to give you a sense of how this can play out, there are dozens of standards out there today that talk about what does ESG include, what indicators does ESG include. And they range from a standard like the Global Reporting Initiative or the Sustainability Accounting Standards Board, which have roughly maybe 40 to 100 indicators that they'll include under the ESG umbrella, all the way up to a standard like the ESG book, which has over 4,000 indicators that are included under the ESG umbrella. Mostly they fit into these kinds of categories, though. So if you think ESG and you think these kinds of topics, you're generally going to be in the right space. So that's roughly a sense of what we're talking about, the types of categories and topic areas that people think of when they think ESG. But I also want to give you a sense of that growth, that ESG is a growing business. It is almost an adult, as we say. And this is just to give you an indication of that growth. This is the projection of assets under management, global assets under management. The dark blue are ESG mandated and the light blue are non-ESG mandated. So that means funds that have some environmental, social, governance aspects that they include into their investment thesis and the portfolio. What's interesting here is that the light blue is projected to roughly stay the same year over year, somewhere in the low $70 billion or $1 trillion worth of global assets under management. ESG mandated funds has been the growth industry, however, though. So you can see it's growing from a projection of 39 up to 96. This projection was a few years ago, and it turns out to be moderately incorrect. One of the reasons that we'll talk about was the political backlash that we had about a year and a half ago to ESG funds. And a lot of funds that called themselves ESG mandated about a year and a half ago got rid of that label. And they said, no, we're not an ESG mandated fund. We're just a fund. But the reality is that those funds kept the criteria for environmental and social risks that they perceived to be financially material. They just got rid of the label. So the actual trend is true. We have seen funds that integrate environmental, social, and governance factors into their investment thesis has been the only growth game in town for the last 5-6 years. So ESG has become over 50% of global assets under management by some estimations. It varies a little bit, somewhere down to a quarter of all assets under management, up to about a half. But no matter how you parse it, it's an enormous chunk of the global economy today thinks about and integrates environmental, social, and governance factors into how that finance is or how that capital flows. So why is this? Why such a huge growth on these ESG data and these ESG criteria? The basic answer is that there's some data to suggest that ESG makes money. So this is just an example from a group of researchers up in Harvard many years ago, back in 2011, or excuse me, 2014. They studied portfolios of companies up to 2011. And what they did is they did a pretty simple comparison. They took two portfolios, controlled for things like sector, region, et cetera, and market cap. One portfolio they called their control case, and then the other portfolio they called sustainability leaders. And the definition of a sustainability leader was pretty simple. It was, did they have a control system like a governance structure to measure or to manage environmental performance? Did they have an environmental policy, and did they track environmental metrics? And if the company had those things in place as of 1991, then they were put into the environmental leaders or sustainability leaders category. And then they just back calculated stock returns based on the control versus the environmental leaders. And lo and behold, they found over that entire time period, almost a 47% improvement on stock performance. This was a really early study, very small sample size, a relatively small sample size. Lots of questions around, what else could have been driving these ESG factors? What are co-correlated factors, et cetera? But overall, it got people's interest. Since then, there have been thousands of studies that essentially ask the same question. Is there a correlation between environmental, social, and governance performance or controls or policies and financial performance, whether it's stock price, return on assets, leverage ratios, Tobin Q, whatever it is? There have been thousands of these. And this is just an example of a summary of those thousands of studies. This one was done for studies just between 2015 and 2020 by a team down at New York University. So they looked at 245 studies that were published, empirical studies, that tested some aspect of financial performance against some aspect of ESG, either control or performance. And what they found was that, roughly speaking, about 50 to 60% of those empirical studies found a positive correlation between the two, meaning that if ESG was an incorporated factor in the financial investment thesis, that company or that fund made more money. Only about 10% or less of the empirical studies found a negative correlation, where they saw a decrease in financial performance as a result of ESG consideration, and the rest were either mixed or neutral. So what does this tell investors? First of all, it tells you that if you're not considering ESG risks and opportunities, you might be leaving money on the table. And that's not a good thing to do as a fiduciary. The second thing it tells you is that it's a relatively safe bet if you consider ESG factors without knowing anything else. There's less than a 10% likelihood that you'll be losing money as a result. But the third thing, and perhaps most important for us going forward, is that this says absolutely nothing about what environmental factors or what social factors or which sectors or which regions or over what time periods those correlations occur. It turns out that the actual relationships between ESG and financial performance are incredibly complicated, but overall, the relationship exists. So that's what investors are looking at. That's the information that they've been facing over the last almost 20 years. And this explains the growth in ESG investments. Investors took it upon themselves to say, I need to know about these ESG risks and opportunities. I need data, and I'm going to incorporate that data in some way into my portfolio because I think that there's money to be made and or money to be lost if I don't. Running alongside this, at the exact same time that ESG data was starting to proliferate, there was another factor that has amplified that interest amongst investors, and that's been the rise of intangible value. For those of you who are old enough to remember the 1950s and the stock market back then, you might remember that the basis of the stock price back in the 1970s was almost entirely on book value. So that's tangible assets that are in the balance sheet, like the assets you have on hand, manufactured assets, cash in the bank, debts, etc. Those are assets on the balance sheet, and those drove most of the value of stocks back in the day. In fact, about about 80% of stock value was on the book value. Fast forward to the 2020s, that has flipped entirely. Now, almost 80% of all value in the stock market is intangible value. That's, reputation, it's brand, it's the perception of investors as to whether this company will outperform in the future. That's what most of the stock value runs now. A case in point is Tesla, which many of you remember from about a year ago, had this incredibly high valuation compared to its book value. And the reason was because investors saw enormous potential in the ability of Tesla to corner the electrification of mobility. And that was worth a lot of money. So why is this important to ESG? Because environmental social governance factors tend to have an outsized impact on intangible value compared to book value. So think about the brand value or the reputation or the potential future revenues of a company. That's where environmental and social risks tend to dominate. That's where climate change might impact on our operations in the future, or our ability to be part of the green energy transition might impact on our ability to sell product in the future. Intangible value, future-looking value, is very, very important in the environmental, social, and governance space. So combining these two, between this rise in data suggesting a correlation and this rise in intangible value, now suddenly there's a huge amount of wealth attached to environmental and social risks and opportunities, and investors have taken note. All right, so our second characteristic of adolescence is this undefined status. So we've seen this enormous growth in ESG, but at the same time, we're running into challenges with ESG. So I want to talk about what ESG is and is not, and where these definitions start to fall down. I tell students in my class, this is probably the most important figure that I'll show them during the semester, and it's a pretty simple one. If we conceptualize, there's a lot of financial data out there. There's thousands of indicators that we'll use to assess the financial performance of a company and to try and get a sense of whether that company will perform well in the future. I'm going to call all of that information financially material information. It has a relationship, a direct causal relationship with the financial performance of the asset. And then the other sphere is this ESG sphere. Again, thousands of data points that we can tap into on the environmental social governance side that suggest whether we are creating environmental or social benefit or creating impact or drag on the economy. And there's some level of overlap between them. There's some information that is ESG by nature, but also has bearing on the financial performance of the asset. That's in the middle of the Venn diagram. I'm going to call that middle the causal data. So this would be any information that the nature of the ESG performance is the reason that the asset performs better or worse financially. So the relationship is causal in nature. Anything sitting around the edges, I'm going to call correlated, meaning that if the ESG factor changes, and we might see a correlated change in the financial performance of the asset, again, up or down. The amount of overlap, however, is not a static concept. This overlap changes for a variety of different reasons. So it could change, for example, for a sector. The oil and gas sector tends to have a higher level of overlap between ESG information and financially material information because they are selling a fossil fuel that results, when it's burned, into climate change. That is a huge part of their financial performance that is tied to an ESG indicator. Other sectors have a smaller overlap in their Venn diagrams. It also depends on the region. In some regions, because of regulation, for example, the overlap might be bigger. If I perform poorly in ESG, I might get regulated and fined, and therefore I have a causal financial performance as a result. Some regions, that overlap might go down. The overlap is also dependent on timeline of the impact. Is this an asset that has a 30-year life cycle, or is this a 2-year asset? Because a longer life cycled asset is likely to have more ESG overlap than others because ESG risks tend to get bigger and bigger over time. So that degree of overlap changes, is very bespoke for the type of asset, where the asset sits, and over what time period. But there's other factors that drive this overlap too, which are based on the perception of the investor. So one investor might look at one of those correlated factors and say, actually, I think that that is financially material. The data doesn't necessarily prove it, but I have this intuition, or I have a set of information that suggests the relationship, and I am willing to take that risk. I'm willing to consider that ESG information because I believe that it will bear financial risk or opportunity for my asset. So the area around that, the overlapping region, that's a very fuzzy area. And it turns out, for those of you who are super interested in this topic, a lot of that fuzziness is really about how much risk is an investor willing to take, which is essentially the definition of their fiduciary duty. Investors that have an interpretation of fiduciary duty that is flexible, they can take on more risk. Those that are very constrained in their duty because of regulation or because of legal precedent, they might not be able to consider that correlated data at all. So this is a very squishy boundary that we're looking at in this overlap of ESG and financial materiality. Sometimes it's going to be very small, sometimes it's going to be very big. Just to illustrate this a little bit, I want to give just a few examples just in the space of climate change. So I'll start with something that's squarely in the middle of that Venn diagram, a causal relationship. And this is a company or an asset that wants to install high efficiency light bulbs, like LEDs. They're going to replace their incandescents with LEDs. How is this going to be internalized? How is it going to cost money or save money? Through the utility bills. So that company will pay less on the utility bill over time, and they will save money. There's essentially no question. This is a causal relationship. We know that by changing those bulbs out, we're going to save money. This is not, by the way, to say that it's the best investment. I might save, I might get a 1% return on my investment for replacing light bulbs, whereas I might get a 7% return for doing something else. So it doesn't mean that it's a no-brainer to do it. It just means that the relationship is ironclad. This is a causal relationship between return and the ESG factor. If I go out towards the edge of that Venn diagram, right where the kind of correlation starts, here's a second example in the climate change space. It's water conservation. Let's say that I have a business and I'm thinking of putting in a water conservation technology. It's going to cost me $1 million to install that technology. At current rates of what I pay for water, it would take me decades to repay that operational cost, right? Because I don't pay that much for water. However, there are some things that might make that return much more appealing to me. For example, there might be a drought where I can't access water as well. And so it would be very important for my business continuity to rely on less water to produce my product. Or maybe maybe the community gets angry about the amount of water that I'm pulling, and suddenly the regulator comes down or the community starts passing policies to restrict water usage, and I'm not ready for that because I'm still using a lot of water I didn't put in the technology. So there are some scenarios where the risk of not putting in that technology accelerate, and the cost of water that I'm going to pay goes higher. Under those scenarios, the return on investment for that water conservation technology suddenly gets a lot shorter. So this is a space where it is correlated. It's unlikely to go the other direction, but under different scenarios, it might become something that becomes a strong financial driver for me, this ESG factor. And then I'm going to push out kind of past the Venn diagram overlap into the space that would normally just be considered ESG information. And this is the example I give here is a company that sets a net zero target. So setting a net zero target, this is different than setting, say, an emissions target. An emissions target, I could say reduce 10% of my emissions and probably save a fair bit of money because emissions are tied to energy and energy is tied to cost. But net zero target says that I'm going to get rid of all of my emissions and offset any residual. That's a big difference from reducing by 5 or 10%. If I set a net zero target, I'm committing my company to do a lot of things and potentially really high costs. So why would I do that? Not only why would I do that, but why are so many companies setting net zero targets? Because it's really unclear that that's going to pay back. So how do they justify it? They justify it through those intangible values. That by setting a net zero target, they're going to distinguish themselves in a marketplace, that they're going to future-proof their company, that they're going to reduce risks, but those risks are all intangible. It all requires taking a leap of faith for that company or that investor to say that I believe that setting this target is going to make financial sense in the future, but I really could not tell you right now whether it will or not. The farther out you push into that correlated space, the more risk you are taking on in your assumptions, in your calculations, et cetera, to say that there is a link between financial performance and ESG. Before I leave this slide, there's one last note I have to get across, which is this is all about financial performance and ESG performance and how they tie together. A company can make the decision to set a net zero target for purely non-financial reasons. It can say it's the right thing to do. It could be the CEO saying that I believe that this is the future and that we just need to do this, even if it's going to cost us money. That is a different question. I'm not tackling that question. That's really not ESG. ESG is about investor criteria, but it's not mutually exclusive. You can do those things as kind of a moral strategy, but I'm trying to keep us to this, the tie to financial performance. As you might imagine, if you've been paying attention to the different, types of ways investors can approach ESG, then you probably won't be surprised that there are many different types of ESG investors. There's a number of different sources out there that categorize different types of ESG investors. I took this one from a gentleman named Kerry Krasinski, who teaches here at Yale. He came up with these 7 different categories of ESG investors. I just want to go through them really quickly, just to give you a sense of, that a lot of different things could be called ESG investing. So the first 2 in red, those are essentially financial investors saying that I'm going to use ESG to make more money. The first is an integrated ESG investor. They're saying I will integrate environmental, social, governance factors into my investment criteria in order to outperform. That's what I'm doing. It's risk and opportunity information. It's all about the finances. I'm not interested in the correlated stuff that's way out on the edges. The value first investor is pure money. Like they're saying, I will calculate financial risks. If they happen to have ESG involved, that's fine, but it's really not important to me. Only if it's a financial indicator will I consider it. The ones in black below it are all investors that will take some level of reduced return by definition in order to integrate ESG factors. So these are concessionary investors. Now I have to asterisk this a little bit. I'm not saying that these other investors want to lose money. I'm just saying that they are willing to consider non-financial information in their investment strategy. And those of you who were here at SOM with me or have taken business classes in the past, you'll know that whenever you consider non-financial information, you reduce the diversification of your portfolio, and therefore you are reducing the efficiency of your portfolio's returns. So let me go through them. Like I said, some won't lose money, but all of them could lose money compared to market. So values first says, I don't invest in something because it's bad. I'm a fossil fuel free fund. I don't invest in gambling. I don't invest in arms manufacturing. They're out of my portfolio. That is an ESG investor. They used to be called SRIs or socially responsible investors. And is a negative screening approach to investing. It is concessionary because you're reducing diversification. Impact investors, again, not trying to lose money, but they ask companies or assets to show them the benefit that they create in the environment and society, and also how they're going to make money. But because they consider environmental and social factors that may not be financially material, they might also be concessionary. Thematic investors. These are the opposite of the values first investor. These are the ones that say, I'm only going to do solar energy, or I'm investing in renewable technologies, or I'm investing in plastics cleanup technologies because I think those are going to make a lot of money in the future. Again, by being thematic, you reduce the scope of investments that you can put into your portfolio, you reduce diversification. Shareholder advocacy says that I'm going to invest in bad companies and try and steer them to be good. So those of you who remember from a few years ago, there was a small investor that got a couple of board seats replaced at ExxonMobil. Their goal was invest in ExxonMobil so that we can get a shareholder resolution onto the ballot so that we can get new board members that are more interested in climate change. They like ExxonMobil, but they want it to move. They want the strategy to change to be more renewables focused and lower carbon focused. That is steering the battleship, or shareholder advocacy. And then the final category is these minimum standards or norm-based screenings. These are investors that look at big social norms like the Sustainable Development Goals and say, I want to invest in companies that are aligned with solving those challenges. You can think of that in two different ways. You could think of that as, I think that those challenges are where all the money is going to flow in the future, so I'm trying to make money. Or you could think of it as, I'm only investing in a portion of the economy that is aligned to what is doing good, and therefore I'm limiting diversification. Either way, there's that kind of investor exists as well. I like to think of investors as fitting into these two basic categories. One type of investor is interested in idiosyncratic risk, and the other is interested in systemic or systematic risk. For those of you who remember your pricing equations, that just means I'm interested in different factors of how the price of an asset is computed. What this results in is, I'll give an example. Large asset funds that are essentially invested across the economy. Think like BlackRock or State Street, most pension funds. They essentially own a little bit of every sector, every region in the world. What do they want in ESG? What they want is they want comparability across their portfolio. If they think there's a risk out there, like water scarcity risk to financial performance, they want to know who's more exposed to that risk than others. So what they really need is they need information that is consistently reported across the entire portfolio, which for them is the entire economy. So when they think of ESG, they're thinking, I want regulations, I want standardization. I don't want all the correlated stuff out on the fringes. I'm interested in the center, but I want consistent information for that information that is almost certainly financially material. This is where a lot of the activity that we see today, and I'll mention briefly in a little bit, pushing for regulations is coming from. It's from these really large asset managers that want standardization of information. And so they're getting their regulator to force companies to disclose ESG information in the same way, in a consistent format, but for a fairly small number of ESG indicators that they consider to be financially material. And I'll come back to that in just a little bit. Compare that to investors that are interested in idiosyncratic risk. They want to know who's going to outperform because of some ESG factor, or who I need to short because of some ESG factor. They don't want standardized information. They want unpriced, complicated, messy, big data sets that no one else is thinking about. So think, hedge funds, shorting funds. These are folks that are looking for that edge of information that is not standardized. So they're very interested in those correlated factors that sit out on the peripheries of that Venn diagram. They're very interested in new technologies that grab big data sets. And their whole purpose is to outperform the market, not to see the overall market go up. All right, so back to my adolescent. More responsibility. This ESG is getting more responsibility and more decision-making authority in financial markets today. So what does that look like? It looks like two things. First, it looks like a proliferation of standards for how companies and asset managers will report on their ESG performance. And it also looks like regulation. There's way too many of these for me to go through in any detail. And I apologize for those of you who really want to get wonky about this. I can point you to a variety of sources, and I've given some toolkits at the very end of this slide deck. Suffice it to say that there's a lot of voluntary standards out there to suggest how companies would report and disclose information in the ESG space. I've noted just a few here: the Sustainability Accounting Standards Board, the Global Reporting Initiative, the International Sustainability Standards Board. There's been movement in this space and some consolidation. So today the SASB and the ISSB are essentially the same organization, and they're working predominantly in the European Union. The GRI continues to kind of stay outside of that fray and push on these voluntary standards. Not surprisingly, where there's a lot of interest from investors, there's a lot of market to make money. So there's a lot of data analytic firms that have popped up with the sole purpose of collecting ESG information from companies, whether that's from self-reported information or from data scraping, machine learning, and artificial intelligence. There's a lot of technology that's now in play by very large companies to collect this information. You'll probably recognize some of these. Certainly Bloomberg, MSCI is a specialized data research firm, and others. So a lot of activities in the voluntary space. But regulation is really where the action is happening right now. I put in the center here the European Union, and all I could do was give you a flag because the European Union is doing so many things right now in the regulation of ESG disclosure. The biggest regulation on the block is something called the Corporate Sustainability Reporting Directive, or CSRD, which requires companies that operate in Europe of a certain size to report on all the material, environmental, social, and governance factors, or sustainability factors, for their company. And they have to do it in a standardized way. It has to go out in the annual financial reports, and potentially most importantly, it has to be audited by the financial auditor. So that means that information is no longer going to suffice. It will no longer suffice for that information to be willy-nilly or kind of, calculated in different methods with different scopes and boundaries. The regulation is trying to tie it down. It's for a very narrow set of ESG information, consistent with those investor expectations. The investors that want that standardized information, they're looking at just the stuff in the middle. And the CSRD is a direct response to that expectation. The EU is not the only place where this is going on. I put a few of the agencies around here in the United States that have been working on standardizing ESG information for the last two administrations, actually, the 2016 Trump administration and the 2020 Biden administration. The effort has been more or less consistent across both. The big kid on this block is the Securities and Exchange Commission. Some of you will be familiar that the SEC issued a rule, came out earlier this year, that said that companies, again of a certain size, have to report on greenhouse gas emissions, scope 1 and 2, or their direct emissions and their purchased electricity and heat, as well as disclose information on climate risks that or financial risks from climate change that will affect their company. That rule is still being litigated, but some portion of it is likely to pass through, and so companies have been preparing it for a long time. To support that, California issued 3 state bills recently. One state bill on greenhouse gas emissions, one state bill on financial risk from climate change, and then a third that clarified those rules. Those also being litigated right now, but that's a California rule, so it's actually significantly more likely to pass through as is. SEC is not the only one putting out regulations and requirements. The Department of Labor has guidance out for how retirement funds for federal employees can be invested. The Federal Reserve System has a number of reports out around financial stability and ESG disclosures. Even the Commodity Futures Trading Commission has a set of recommendations out. All of them are essentially in the same place, saying that we need standardized disclosure from companies or from traders or from asset managers to understand the nature of the risk that we're looking at. All of them are financial in nature. None of these are about what you should do. These are all about what makes financial sense. I want to just mention this one. I mentioned climate change several times, from the European Union, from the SEC, and from the California bills. All of those are actually tied to one voluntary standard called the TCFD, and it's worth knowing if you're in the space at all. It stands for the Task Force on Climate-Related Financial Disclosures. It was written in 2017. Every one of those regulations refers to the TCFD. So if you're a company or an asset manager and you're thinking, well, what kind of information do I need to disclose in the climate space? This is where that information is that guidance is. So for those of you who want to, it's a good read. Now, the last factor here on the growing up is that Not only is it voluntary disclosure and regulation, but there's also legal liability that is emerging as a result of the ESG information. And it's happening on both sides of the coin. So companies and asset managers are now being sued by a number of different stakeholders for a variety of different ESG aspects. For example, I was one of my summer activities this last year was to serve as an expert witness for a case in Australia. An oil and gas company had put out a net zero target several years ago, and they were being sued by shareholders because the shareholders claimed that setting a net zero target constituted a financially material strategy for the company, but the company had not done sufficient financial due diligence on their net zero strategy to convince shareholders that they weren't going to lose money as a result of that commitment. That's coming from one side, but companies are getting it from the other side too. They're getting it from, the lawsuits against ExxonMobil, for example, that claim that the company was misleading shareholders about the nature of the risk from climate change, and that by avoiding the reducing of climate emissions, ExxonMobil was increasing the risk to shareholder returns because of climate impacts. So it's coming from both sides, and these lawsuits are gaining traction around the world. I always warn I'm not a lawyer, so I'm not going to suggest which way you need to go or which side you need to be more worried about. But companies do need to be concerned about ESG information today. It's no longer sufficient to just wave your hand and say, let's put some information out there. We are creating liability as a result of ESG information if we don't do our due diligence. So it might make sense that given all these different factors of growing up, that ESG is coming under a lot of pressure. Once there's money involved, then a lot of stakeholders are going to start pressuring you. So I want to talk a little bit about the political environment around ESG, because I know a lot of you have heard about this, you've seen the headlines. It turns out that the political pressure or backlash on ESG is coming from both the left and the right side of the aisle. On the left side, the criticism is that ESG has been held up as kind of the hope for the world, that we can make our money and we can save the environment and society at the same time, that it's all win-win, that ESG is the solution to moving money towards more sustainable ventures. And the political left is arguing that's not true. This is just business as usual, and we're glossing over environmental and social impacts by claiming that it's a win-win situation. And at the end of the day, it's essentially just greenwashing. The gentleman on the right here is Tariq Fancy, a former investor with BlackRock, and he's been one of the kind of vocal critics of ESG for this reason. You also see it coming from the political right. So the right side of the aisle is arguing that ESG is a distraction from your fiduciary duty, that your responsibility as an asset manager or the leader of a business, a for-profit business, and your responsibility to your shareholders is to maximize return, and that consideration of environmental, social, and governance factors is a distraction from that focus, that these are not factors that we should consider when making investments, and therefore they should be banned. We should not allow asset managers, for example, to consider ESG. We should not allow companies to have DEI, diversity, equity, inclusion programs, because they conflict with the fiduciary responsibility of the company. So we're getting it from both sides. It turns out, and if you read into these just a little bit, this is a really false debate. So these parties, the parties on the left and the parties on the right that are making the noise, are really not talking about the same thing. On the one side, what they're talking about is really value first and integrate ESG strategies, and they're claiming that those strategies do not prioritize social and environmental impact. That's what the left is saying, and they're correct. Those approaches to investing are financial approaches to investing. They would only consider social and environmental factors if they are financially material. So they're not going to save the world. There's a lot of social and environmental factors out there that don't help the business make money, and so businesses aren't going to solve them. But on the other side, what they're really talking about is the ones in black, the investment strategies in black, the ones that are concessionary, the ones they're saying, values first or impact screening or negative screening investment strategies, that those are concessionary. They're going to lose money. And they're also right. The problem is they're both calling them the same thing. They're all calling it ESG investing when they're really talking about entirely different investment strategies. So, and then to add to all this, both kind of edges of the political parties are really cherry picking their data right now to try and make a point. At the end of the day, it's complicated, as I mentioned earlier. And the boundary between what is financially material and what is ESG is very blurry. And it's up to the investor or the company and how they treat these things to determine whether and how much risk they're willing to take, and therefore whether ESG is financially material or not. Okay, so I want to talk about where ESG is kind of going now. What are we trying to? I'll start with what we're trying to fix in ESG. What are the challenges that we're trying to overcome? I'm going to go through these fairly quickly. I pulled these from a paper that I wrote with Professor Dan Esty at the School of the Environment / Law School. And we talk a lot about the data. And these data challenges, even though they've been around for a long time, they're still prevalent. So there's a number of challenges we have with the data. Like a lot of the data that we have is about the operations, not about the reputation, which means that we've got the book value ESG impact, but not the intangible value ESG impact. That's much harder to measure. We tend to have backward-looking information, not a whole lot of forward information. We tend to have a lot of information on risk and not much on opportunity. So the downside of ESG is much better known than the upside. And it's maybe most troubling in terms of this first category of challenges is that there's been very inconsistent boundary and coverage around ESG data. Now, fortunately, today, because of those regulations, this issue is starting to fix itself. So the regulations are standardizing that boundary and that coverage and that scope. They're starting to say this is what is a backward or forward-looking piece of information, and therefore how the auditor would treat that information. So we're starting to nail this part down around the scope and boundary issues. We still have methodological issues in that data. Real inconsistency in how we measure ESG information. I'll take a really simple example, which is greenhouse gas emissions. How much CO2 do you emit as a company? It turns out that less than 1% of all emissions is actually measured. The vast majority of emissions is calculated based on mostly sound scientific calculations. If I burn a gallon of fuel, say diesel fuel, I know essentially how much carbon dioxide is produced. But there are assumptions behind that around how much is left over, what kind of engine we're talking about, are there any sequestrations involved, is any captured in the exhaust system, etc. So I'm making assumptions at a very large scale rather than actually measuring emissions. CO2 monitors tend to be expensive. They're only worthwhile on stationary sources. So we don't have a lot of measured data. And that's for the most easy to measure factor in ESG there is. Now think about something like, did I violate someone's human right? That becomes a very difficult thing to measure. And so we're estimating and calculating and making assumptions around a lot of the data that we're using to make decisions. Where there's gaps, we fill the gaps. And sometimes we don't even know how people are filling the gaps. They might be using an average. They might be assuming nothing. It's a very big black box in the data that's out there, and lots of challenges. This is particularly true in that voluntary data and those big data sets that people are using to try and get unpriced information. And that kind of suits those investors, right? They want it to be unpriced. And so they're okay with these methodological issues. They're trying to find the best data to support their own decision making. They're not trying to standardize it. Another place where things are moving rapidly is in the type of products that are coming out, and the kind of new and innovative financial products. And I don't really have time to go through all of these. I'll just note you've probably heard of some of these. For example, you've probably heard of green bonds, which are bonds issued by a municipality or a sovereign or even a corporation that say, we are going to use the proceeds from the bond to do something green, whether it's energy efficiency or renewable energy or reducing pollution, etc. So you probably heard of that kind of thing. You may have even heard of things like blended finance, where a concessionary investor will say, I will underwrite the first loss, or I will give the first, say, tranche of capital to a very large investor in order to attract the other 90% of capital from market rate investors. And because they've reduced the risk, then they can come in at a reasonable risk return ratio. But there's a lot of different products that are coming into the market that are ESG related. Some of them are super interesting, super clever, and are scaling quickly. Some are maybe too clever for their own good and having a little trouble scaling. But lots and lots of activity out there. And I encourage anyone who's interested to have a look. The next thing that's happening is this rise of big data. I put a few pictures here, and I'll try to go through them quickly. Just some examples of what type of data we're pulling. On the upper left is just an image of a hurricane track. Turns out that hurricanes cause a lot of damage to businesses. And investors, particularly short-term investors, are very interested in that damage. So increased frequency and increased severity of hurricanes means that if I know something about where that hurricane will hit, and I know something about the assets on the ground where that hurricane is going to hit, then I can invest accordingly right before the hurricane hits. An example I heard of several years ago was pharmaceutical companies that are on the grid that have storage facilities. They have to, those storage facilities have to be refrigerated 24/7. If the refrigeration goes off for even a minute, then the stock is useless. They can't sell it. So investors would look in the Houston area and they'd look and see which pharmaceutical companies, based on satellite data, did or did not have backup generators at their facilities. And right before the hurricane hit, they would short those pharma companies because they were reasonably sure that the electricity would go out and that those storage rooms would go offline for at least an hour, which means that all the stock in those spaces would be useless. So that kind of a big data set to try and use ESG information to make an investment decision. Lots of information using sentiment analysis, essentially asking, do people like what you're doing in ESG or not? Because if a lot of people are getting angry about your ESG performance, and I know that you're dependent on intangible value for your stock price, then I will start to remove you or de-weight you from my portfolio. And the bottom left is it's another interesting satellite data approach to investing. This was using satellite data to measure the shadow on floating lids for oil and gas storage depots in China. So China is the number 1 buyer of oil in the world. They predominantly use floating lids on their oil tanks at ports. So when those tanks were getting low, meaning the lid was down low, we know that the country was going to increase its purchase of oil and gas, and we know that will drive very, very small margins on oil and gas global prices. So we use that kind of data around demand to figure out demand scenarios. The last one on the lower right, it's a microphone in nature, and it refers to this data set that measures biodiversity based on the sounds, the diversity of sounds in forests. And so we can measure the impact of companies or company activities on ecosystems and biodiversity, and we can use that data to weight our portfolios based on whether we think someone will, come down on that company or charge that company as a result of the degradation. So lots and lots of interesting big data sets that are being used in the ESG space. All right, my final slide, and then I'll stop. And I'm sorry, I went a little bit over. Where are we going? Where's ESG headed now? So the first I've mentioned is we're consolidating and standardizing the core of ESG. Those factors that we are reasonably sure or have demonstrable evidence of a link to financial performance, we're getting our act together to get that data standardized and comparable across entire economies and portfolios. We're using regulation to do it. We're using voluntary standards to do it. We're using shareholder pressure to do it. And we're seeing consolidation not only of the data itself, but also of the main organizations that are pushing those standards forward today. That's trend number 1. Trend number 2 is going the exact opposite direction, which is an expansion of these big, messy, unpriced data sets using new technologies, artificial intelligence, et cetera, to scrape vast amounts of information that is unpriced on the marketplace so that investors can find that nugget of information that's going to drive out performance for their selections and their assets. And then finally, we're seeing this shift from politics and the backlash of politicians to litigation. The political scenario is more or less settled out. There's the edges, there's the fringes of the political parties that argue about what ESG is and is not, But in the middle, most asset managers and most companies are proceeding with ESG because they recognize it as financially material. So we're moving now into the litigation space, which is if you use that in ESG information to make financial decisions, then you should be very clear on whether you've done the due diligence, the financial due diligence on the impacts of that information, whether it's forgetting to do the due diligence or doing too much due diligence, as it were. And so we'll see a crystallizing of fiduciary duty and what are the responsibilities of people that use ESG information. We'll see kind of a ratcheting down of greenwashing as the expectations and the testing of this information increases. And we'll see much more stress testing of what are the scenarios under which this ESG information becomes financially material to me. So I'll end there. I will stop the sharing. For those of you who have, if you can get access to the slides, I've just added a couple kind of toolkits of different things going on in the space that as a reference, courtesy of the World Business Council for Sustainable Development.
Thank you so much, Todd. That was fantastic. And lots of really great information and presented in a simple and easy way to understand. So really appreciate that. I know there was quite an active conversation going on in the chat. For all of you who put questions in the chat, please could you put your questions in the Q&A box? That's going to help me to make sure that we answer all the questions that were posed. I want to start with Lori's question. Lori says, given the use of algorithms driven primarily by decreasing risk and increasing financial performance in money markets, which includes small amounts of many different investments in many companies and stocks, can investing with ESG impact objectives really be actualized? Instead, should ESG impact investors be invested in very few stocks and companies and be an active stakeholder in these investments?
Yeah, it's an interesting question. So impact information is obviously a type of ESG information, but impact does not necessarily carry that financial correlation requirement, right, or financial performance correlation requirement. So I might, for example, I might want to know how many children are in my supply chain, which is an impact consideration, even if children in my supply chain doesn't impact my company. Maybe it only impacts my suppliers, for example. So just to distinguish between the two. And the reason I start there is because it's essentially the same rules of engagement for impact metrics as it is for ESG or financially material ESG information. That is that you can measure impact across large portfolios, but it's going to be a pretty small swath of information that you'll be able to get comparable, consistently reported, validated, standardized information, even in the impact space. So the bigger your portfolio, the more, I don't want to say, I'm going to use the word superficial, but that's not the exact right word. The bigger the portfolio, the more shallow your impact assessment is going to be because of that need for comparability. If you really want to understand outcomes and outputs in the impact space, you want to know how many people's lives have been impacted. What is the quality of life change as a result? What does access to water look like in the community? Then you're probably, that is fairly bespoke and tailored. So you're probably going to have to limit that to a very small portfolio and focus on a smaller number of companies. So it really kind of depends on what type of an impact investor you are.
Okay, fantastic. There are some folks who are here because of their personal investment portfolios, and there are folks who are here, through their business connections and interests. So a great variety of questions coming in. Let's go to Lee's question. 2 points seem contradictory. 1,000+ studies showing mostly positive results from ESG investment, but most of the types of investors are concessionary.
Yeah, I actually removed a slide that would have answered this question. And that is that there's 7 types of investors, but the distribution of assets under management is not equal between them. So the first two types, the fiduciaries, have the lion's share of assets under management. ESG integrated funds in particular, I think, constitute over 80% of quote unquote ESG funds. So that data showing the correlation, that's being used by the bulk of investors to say, all right, there's something here that I've got to think about.
Okay, and on the topic of scoring, people are interested. There are a couple of questions about scoring. So I'm going to start with Stefano's question. I hope I'm saying your name correctly, Stefano. Does an ESG score reflect the impact on the environment of the core business? So imagine, for example, that a fossil fuel company has an excellent social and governance practices, and they are an industry leader in environmental practices in the way that they conduct business. However, the manufacture or consumption of their fossil fuels is enormously destructive to the environment. Will their ESG score reflect the inherent harm of their product?
Ah, great question. And the answer, of course, is it depends. So it depends because there's different scoring methodologies out there. So let me take just a couple of examples to illustrate. So MSCI is probably one of the biggest investor-focused scoring methodologies for ESG out there. MSCI they rate companies or assets based on a scale of AAA down to triple C. They are what you'd call a comprehensive ESG scoring methodology. So they look at not only past performance, but they also look at control mechanisms. They look at not only fossil fuel use, but also human rights. So they'll look at the impacts across all what they consider to be material categories. So in that case, that score should reflect the net of all those different potential impacts. The caveat there is that they are bespoke, so they won't, for example, think what are the impacts of plastics waste for the financial industry, right? It's got to be a material topic to that sector for them to include it in their scoring. But they are a net score. There are other scorers cards out there that are not net or that overly weight some factors to others. The most common is fossil fuel and climate change. So there are a lot of scorecards out there that are essentially, we're just interested in your climate change impact. You might be having huge social harm as a result of your activities, but we're only measuring climate change. And so they might get a really good score, even if they treat their employees terribly. This came out their headlines a year and a half ago around Tesla, because Tesla was number one in one ESG ranking and number not one, like way down in another ESG ranking. And it's because one ESG ranking was heavily weighted towards kind of the electrification, battery technology, and greenhouse gas reduction potential of Tesla. The other one that rated them lower was more heavily focused on complaints from workers. It was right after the COVID controversies where workers had to go back to the Fremont factory. And so they dragged the score down because of the social impacts that Tesla was having on its workers. So it depends on the rating that you're looking at. What I usually get this question in the form of, so what should I invest in? What scorecard should I use? My answer is you have to read the prospectus. You have to find out what that fund or that asset manager means when they say ESG. If they just mean ESG integrated, they're probably talking about like an MSCI type scorecard. But if they're saying like, we're a climate or fossil fuel free fund, then they're probably ignoring all the social stuff. So you could be creating social harm while they try to solve for the environmental stuff.
I know there are lots of folks out here who are thinking, that it's a real complicated landscape, based on what you just described, and figuring out how to navigate it is a challenge. Do you have any suggestions for resources that people could take advantage of if they want to develop an expertise in being able to discern this balance between, for example, environmental harm versus social harm?
The question is, how self-serving do I want to be here? I might as well start there. I have a few books out. They're not easy reading, and I apologize. They're fairly technical in nature. So we have 3 edited books out now that are all devoted to the space of ESG and financial performance. So all about this interrelation. I think we've cut, a lot of good papers in there by a lot of great authors. If you're into a little bit more of the wonky side, um, if you prefer more the light reading, the popular reading, maybe like the thing that you'd find at the bookstore. There's a great book out a few years old now by Andrew Winston and Paul Pullman, called the Net Positive Company. It talks about, it's kind of in the name, the net positive. It talks about how you balance these factors against each other. Mostly it's about how companies can take risks to be more responsible, how you can push the boundaries of that overlap. But it also talks about that net scorecarding. And then there's a third book I'd recommend from one of our alumni. Her name is Urvashi Bhatnagar, and she wrote a book called The Sustainability Scorecard with Professor Paul Anastas, who's at the School of the Environment and the School of Public Health. And it's a net impact scorecard proposal. It's like they gave a suggestion of how that could work. So I'll point you in those places, but there's thousands of books out there, but those are some that come to mind.
Really helpful to have that information. Thank you. I know a lot of folks are checking out those books. We will put links to them in the chat for you if you're interested in them. There was someone who had, since you brought up the point about net positive, let's go to something which is slightly different, but has the word net in it, net zero. Stefano wants to know, when a corporation sets an ambitious net zero target for a relatively far future, is there any accountability? What's the risk of an insincere promise to reach short-term greenwashing with no intent to follow through?
This is a core question in that court case that I mentioned that I was involved with in the summer. The answer is going to be a little disappointing, and I'm sorry. The answer is that a company that sets a net zero target the data suggests that it will get a very short-term bump in its stock price, kind of the reputational benefit of setting a net zero target. But there have now been enough companies that have either publicly or privately reneged on their net zero commitments, meaning they've either publicly said we are going to get rid of our net zero target, or they've put information out into the public domain that shows that they are not meeting their net zero target. There's enough of that data now that we can test, and the answer is that there's no downside to that. So companies will remove themselves from these net zero targets, and the stock market price, at least, does not reflect any movement as a result. On the litigation side, there's definite downside risk to setting that target, which I mentioned. There might be downside risk to reneging on the target. But the problem is that if you decide that, you know what, we can't make it, or we don't want to do this net zero target, there's not a lot of plaintiffs that have standing on that. The only lawsuits that have really kind of moved forward right now are the ones that are claiming greenwashing. That say essentially, but they have to prove that not only did you step away from your target, but when you said it, you knew that you would not make it. Right? They have to prove that you're giving false claims when you set the target, and that they have standing, meaning they have damages as a result of that claim. That's pretty much the only kind of hammer that's coming out around companies that step away.
Really interesting. I note that John commented earlier that a certain amount of this sounds like substance over form, whereas ESG matters in terms of investment performance, but the branding backlash has pushed investment managers to rebrand. And this sort of like this comment speaks to your point about the sort of intangible public image of a company, as it says, for example, we're going to set a net zero target, or we're prioritizing ESG factors, to what's actually happening. It can become a part of your brand, but not actually really be part of the substance of what you're doing.
Yeah, and this is where the regulations are actually going to help. The regulations won't stop marketing for green or sustainable attributes. Marketing and intangible value and reputation will continue apace. We'll continue to see companies claiming, to do great things. And in all fairness, some of them are doing great things. But the regulations are going to trying to put a bright line between those marketing claims and the financially material performance data on the other side. So they're, and the way that they're doing that is they're saying, if you're claiming that something is financially material, ESG information is financial material, then it's going to have to go in your annual financial report, and there has to be an auditor that's going to sign off that you have treated that information correctly. So now, if I say, let's say I take a piece of ESG information like energy efficiency, and I say, this is financially material, it's in my annual report, the auditors check the information, they've checked my response to that and how I've responded to shareholders. Now, if I back away from that performance and I say, you know what, we're not going to make our energy efficiency targets, now the shareholder will say, well, you told me it was financial material, and the auditor verified that. So you are going to make less money, according to you. According to your balance sheet projections, you're going to lose money as a result, and I can act accordingly. So in that case, it's not retribution. The reaction is going to become because you said it was financially material information and you validated that. Whereas the marketing claims will stay outside of that realm. They're not financially material. The investors will not make decisions based on those. It might impact on your customers. Will they buy your product, et cetera? But that's not, that's for them to decide. And that's just marketing. And you're very protected for marketing speech. So the benefit here is that we won't see less greenwashing, but we'll see a very bright line between information that is not greenwashed and information that could be greenwashed.
Okay, I want to go back to the ratings for a moment because there still were quite a few questions about that. Arthur wants to know Morningstar's ratings of ESG, if you could discuss those and if you're familiar with what the foundational principles of those are.
Yeah, the Morningstar rating is another net rating, so they consider social and environmental factors. The Morningstar is for funds, and I think Arthur might mention that. It's not for companies, so they're not assessing the quality of the companies in the portfolio. They're assessing the approach of the fund to integrate ESG information. So they look at things like, what ESG information does the fund consider? Do they have the governance structures to follow through on that? Is it integrated into the investment committee's decision making? What kind of data does the fund use to assess? So it's more about the quality of the procedures that the fund uses to assess ESG. That's important because one fund could say, we're only doing climate change, and they could do it really, really well. And Morningstar would rate that fund highly because they are doing exactly what they say they're going to do in their prospectus. Another fund could look at lots of different impacts and do it poorly, and Morningstar would rate them poorly because they are not following through on what they say they're going to do. So it's a net scoring, but it's net for the asset manager, not for the portfolio companies.
Interesting. Okay, I want to go to John's question. Does lack of timeliness in government financial reporting, so for example, some audited statements arrive 12 to 18 months after the end of the fiscal year. So does that lack of timeliness need to be addressed before such entities and their bond offerings can be fairly reviewed in any standardized ESG evaluation?
Yeah, this is not unique to the financial statements. ESG information, voluntary ESG information is probably even worse in terms of timing. It's always at least 12 months old. I think the answer here is more about who the user of the information is. So I think John is leaning towards, the question is leaning towards standardized ESG information, meaning so that would be the investors, like the big asset managers that are looking for kind of that standardized information across the entire portfolio. Now remember that those investors are interested in kind of covariance. They're interested in volatility. They're trying to reduce beta. They're not looking for alpha, right? They're not looking for outperformance. They're looking for overall portfolio performance. So also the kind of financially material information that they're seeking to get standardized tends to not be the what's the term, the black swan events. They're looking, it's more chronic drags on portfolio performance. So I think most of the standardized information will probably be okay at a slower clip, coming out. And then, in most finance, even an annual report, it's going to be less than a year old. Um, the but that kind of pace is unacceptable to those alpha investors, right? The hedge funds, the ones that are trying to outperform. They're interested in sometimes some really short information, short-term information, in order to make their investment decisions, and they make them very quickly. So I think overall, the ESG information coming out for standardized type investors, big asset investors or asset managers, it's probably going to be roughly the same quality as you would get in the financial statements anyway. But to John's point, it's absolutely unacceptable. That information, that standardized information is useless to other types of investors.
Okay, and I think we have just one more question that I'd like to get to, and that is Lori's question. Are you worried that fossil fuel and other major polluting companies will declare a sort of a future bankruptcy, as was done by the asbestos industry in the past, because of the growing risks from legal actions related to climate and other environmental change?
Um, we were seeing that for a little while in the coal industry. So we saw coal was starting to, file for bankruptcy, consolidate. Some assets were being bought and then they'd buy companies and retire a lot of the assets. Um, the the funeral dirge for coal was probably a little premature. It's still a presence here in the U.S. and it's still actually growing, I believe, in China. And because international coal prices are now sufficiently high, U.S. producers can now export and compete against things like natural gas. So it's a premature call for death for coal. But that said, there's certainly some people that believe that there will be this cascading, retirement of energy companies. First, coal will go, then heavy oil industries, oil sands will go, then liquid oil extraction will go, then natural gas. That time period for that to happen, that's a long time. We're not talking decades. Even coal, if you had asked me that question maybe 3 years ago, I would have said, oh, coal won't be around by 2030. It probably will be around by 2030. But that's if you want the answer to that question, watch the coal industry. If the coal industry actually starts to peter out, then I think you can expect heavy oil will start to come under pressure after that.
Well, since you mentioned a forward look, I'd love to sort of round out this conversation by asking you about your sense of forward look. The theme for your presentation is ESG enters its adolescence. And I guess I'm wondering, is there any evidence in its adolescence that it's moving the needle on the ground in terms of real outcomes for our sort of global, a collective, collectively as humans on Earth, for our global ambitions for climate change and solving climate change? Is there any evidence that ESG is really in its adolescence now moving the needle?
Yeah, I mean, we have this catchphrase at Center for Business and Environment we call it optimists taking action. So I feel almost duty bound to call myself an optimist. So there's a few indicators. So take clean energy, for example, accelerating past any other energy in the world. Solar, wind growing faster than any other type. There are subsidies involved, but it's also fighting an uphill battle because of the lack of infrastructure, for electrification. So the fact that it is accelerating this quickly is amazing. Could go faster, want it to go faster, actually needs to go faster, but it's going quite rapidly. There's other indicators that are not necessarily good news, but less bad news. So we are bending the curve on climate change. Again, not fast enough. We're still not on track for 1.5 or 2 or barely even 3 degrees at this point. But we're not really on track for 7 or 8 degrees anymore. So, no world-ending climate change, just catastrophic climate change. There's biodiversity degradation has also slowed. Again, still rising, but not as fast as it was. So there are indicators that of kind of scaled impacts. It's just it's not enough. And the other caveat there is that, as I said, the businesses and investors and the movement of capital is not going to save the world. A lot of what we need to do it does not make financial sense. It's going to cost money. It won't make money. And so we can only rely on kind of ESG and finance to get us so far. I don't know how far it will get, even if we were perfect at it, probably, it's not going to solve most of the challenges that we have. So even if I claimed 100% success in the ESG space, I'd still say there's more to be done because there's a lot of stuff that's going to cost money.
So let's say we have you back several years in the future and the topic is ESG enters its adulthood. What is your sort of forward look prediction on what might be different between now and then?
First, I'm glad it's called in its adulthood and not in its retirement. I think at that point, I made this projection actually several years ago with the Washington Post, the Wall Street Journal asked a variety of people how much in 5 years, how much of assets under management would have ESG integration, and I said at the time 100%. And I kind of stand by that still. I think that all investors consider ESG now to some degree or another. So in its adulthood, what it means is that it is a mature financial market that is very clear what information investors want to use. If they want to use that information, they feel confident in it. It's validated, it's audited, and the due diligence is established when they use that information. And that there's speculative information still on the market for those who want that unpriced information. That's a mature financial market. And that's, I think, what adulthood looks like. There's no more debate as to whether we should or should not use it. There's no debate on what's included underneath the umbrella and what the difference is between investment strategies. There's no question on what we have to report or what we can report. There's messiness still. There'll never not be messiness in financial markets, but it'll be clearly defined what information is worth what to which investors.
Fantastic. I think that's a great note to end on. I want to thank you, Todd Cort, for being here today in our 5th annual Climate Change Conversation series. Our next conversation is tomorrow afternoon at 12 o'clock Eastern Time. It's called The Burning Earth, A History, and presented by Sunil Amrith. I also encourage you to watch the recordings of other conversations. They're all available on our alumniacademy.yale.edu website. The books that Todd has mentioned will be linked on that site, along with the slides from today's presentation and the additional resources that you have so generously shared in those extra slides that you mentioned at the end of your presentation. So please do check those out. And I'll turn it back to you, Todd, for any last word you'd like to have.
Just thank you all. It's great to connect with someone from Three Rivers. Great to see a couple of the folks that I've worked with in the past. I hope everyone got a little something out of this, and keep diving in. It's a complicated but fascinating space. So I encourage everyone to keep doing their reading.
Wonderful. Thank you so much. See everybody at the next one, and we'll be in touch, Todd. Bye-bye.
Thank you. Bye.